On October 30th, Rachel Reeves announced some of the biggest changes to pensions for almost 15 years. These changes are so significant that some people are now questioning if pensions are worth it anymore. As financial advisors, my team and I have spent the last week assessing the impact of these changes and how they are going to fundamentally change the way that many people should be planning for retirement. So, in this video, I want to tell you what rules have changed, but more importantly, how they affect the way that you should be using your pension. As part of this, I'll address the three biggest questions I'm being asked at the moment. What are the rules, and is it likely that they're here to stay? If I'm still working, should I stop paying into my pension? If I'm retired, should I take my tax-free cash or change the order in which I'm drawing down from my assets? Let's start by demonstrating what rules have changed with an example. Henry is 70 years old and has two grown-up children. He's divorced from their mother but is now living with a new partner. Henry owns a property worth £400,000 with no mortgage. He has £500,000 in ISAs, £250,000 in a defined contribution pension, and a defined benefit pension that pays him £5,000 per year. He currently spends £20,000 per year, which is covered by his state pension, his DB pension, and by making small withdrawals from his ISAs or his DC pension as required. Therefore, his main objective is to leave as much money as he can to his children, especially as one of them has learning difficulties and will need financial support throughout the rest of their life. If Henry passed away today, this is how his estate would be assessed for inheritance tax purposes. He has a IHT nil rate band of £325,000, and if he leaves his home to a direct descendant, he also has a residence nil rate band of £175,000, meaning that he can pass on £500,000 free of inheritance tax. At the moment, his defined contribution pension falls outside of his estate, which means that his taxable estate would be £450,000, so no inheritance tax would be due. His defined contribution pension could also be passed on to his children, who would then have the option of receiving it either as a cash lump sum, converting it into an annuity, or keeping the money inside a pension wrapper known as a nominee pension and drawing it down as required. However, not all pension providers offer these options, which can create big problems, as I'm going to show you later. Now, because Henry died before the age of 75, his children would not have to pay any income tax on the money that they receive, which means that if Henry died today, he can pass on his entire estate free of inheritance tax and income tax. If, however, Henry died after the age of 75 and left his pensions to his children, they would have these same options but would need to pay marginal rates of income tax when they receive the money. These pre- and post-75 rules are not changing. What is changing is that from April 2027, Henry's DC pension will fall inside of his estate for inheritance tax purposes, as will any lump sum death benefits from a defined benefit pension. Which would mean that instead of paying no inheritance tax on his estate, there would be a bill of £80,000 to pay. This is made worse by the fact that the government has also frozen inheritance tax bands until 2030. To demonstrate why, let's assume that instead Henry dies in 5 years' time at 75 years old. Let's also assume that over that time, inflation has been running at 3% per year, and Henry's assets have grown in line with that. Which means that now his taxable estate is £811,000, but because the nil rate bands have been frozen, the inheritance tax due would be £124,000. What's more is that because Henry has died after the age of 75, his children would have to pay their own marginal rates of income tax when receiving funds from his pensions. And the danger here is that many pension schemes, especially cheaper workplace schemes, will often only allow your beneficiaries to receive this money as a cash lump sum. If split 50-50, each of his children would be set to receive £86,000 from his pension, which would be added on top of the income that they have earned for the year, which means that they could end up paying 40% tax on that money. Meaning that from Henry's original £289,000 pension, his children could end up receiving only £104,000. That's an effective tax rate of 64%. So this is the problem. Not only are people's taxable estates getting larger because pensions are now being included, but because inheritance tax bands have been frozen, inflation is going to result in more and more people's estates being pushed above these inheritance tax thresholds. Normally, we only think of inheritance tax as something that very wealthy people end up paying. But if the government keeps freezing these bands, or inflation picks up, we could find ourselves in a position where estates of £300,000 in today's money, or perhaps even less than that, are facing inheritance tax charges. Before we move on to discuss what you can do to mitigate this and the new meta for retirement planning, let's clarify how these new rules are expected to work in other situations. Firstly, if Henry was married, between him and his wife, they would have two sets of IHT allowances, so they could pass on up to £1 million without paying inheritance tax. As it currently stands, if Henry is the first to die, any assets he passes to his wife on death would not attract inheritance tax. This rule is not changing. So, if Henry left his pension to his wife, no inheritance tax will be payable, and if he dies before 75, she could inherit his pension without paying any income tax, which is still a fantastic benefit. But if he dies after 75, she would need to pay marginal rates of tax on the money that she receives. However, when she then dies, inheritance tax may be due at that point if her estate is above £1 million at that time. It's important to remember that these changes are slated to come into effect from April 2027. So if you die between now and then, your pension would fall outside of your estate. However, these rules are not yet written into legislation. There is an ongoing consultation about them, so I'm getting a lot of questions from clients about whether they'll actually stick, and even if they do, whether a future Conservative government might just roll them back again. So let me address this question. Firstly, the questions being asked as part of this consultation are not about whether the rules should be changed, but about the best way to implement them, as the initial ideas are looking like pension providers are going to be required to do a lot of the work and arrange for IHT to be paid directly from a pension, which would make probate even more of a nightmare, as pension providers often have terrible customer service. Secondly, it's impossible to know for certain what a future government might do, but in my opinion, I think it's highly unlikely that they would roll back these changes in the future, because pensions falling outside of your estate was, in most people's opinion, an overly generous benefit that has distorted the way that people were using pensions. So I think that these rules are here to stay, which means that as of 2027, many more people will be looking at the prospect of paying large inheritance tax bills. So how does this change the way that you should be using a pension as part of a retirement plan? Well, that's very much going to depend on what you're trying to achieve and your personal situation, both now and in the future. Let's say that you're currently working and you have £1,000 that you want to save towards your retirement. The two main tax-efficient options you have are putting that money into a stocks and shares ISA or into a defined contribution pension. Once money is inside these wrappers, you can choose how it's invested, and that money will grow free of income and capital gains tax. And from 2027, both of these will fall into your estate for inheritance tax purposes. You can start drawing money from a pension once you turn 55, although this limit is going up to 57 from 2028, whereas with an ISA, you can access that money whenever you want. But if your goal is to provide income for yourself in retirement and you don't need the flexibility of an ISA, which of these is better? With an ISA, you get no tax relief on the way in and pay no tax on the way out. Although, in reality, the money within your pension and ISA would be invested and grow between now and retirement, I'm going to assume no growth here because it makes it easier to see the effects of tax relief. With a pension, if you're a basic rate taxpayer, at a minimum, you'll get 20% tax relief when making a pension contribution, which immediately boosts your money to £1,250. And then in retirement, you can draw 25% of your pension tax-free, whilst the other 75% is taxable at marginal rates of income tax. So let's say you retire at 57 and have no other income coming in. You can draw £12,570 from the taxable part of your pension, on which you would pay no income tax as it falls within your personal allowance. And if we then include the 25% tax-free that you would also need to take, you would get £16,760 per year tax-free from your pension. So if you manage this well, you should be able to draw the money out of your pension without paying much tax at all, which would leave you 25% better off than with an ISA. If, however, your employer uses a salary sacrifice pension, you could get 28% tax relief on your additional pension contributions, because then you'd also save on national insurance. And maybe your employer might even match those additional contributions. In these situations, a pension is clearly a very powerful tool for saving for retirement. Most people move down a tax bracket when they retire, which is what makes pensions so effective. So if you are a high rate taxpayer and you get 40% tax relief going in, and then let's say you draw £50,000 per year from your pension in retirement, if we assume that you have no other income coming in and that 25% of that is tax-free, your overall tax rate on withdrawals would be just 10%, which would leave you 50% better off than if you'd used an ISA. Even if you did end up having to pay the same amount in income tax when taking money out of the pension as a tax relief that you got when putting the money in, you'd still be better off than using an ISA because of the 25% tax-free cash part of your pension. However, the maximum amount of tax-free cash you can draw from a pension is £268,275. So once your pension goes above £1,073,100, or you think it's already on track to do so, any additional pension contributions you make won't get you more tax-free cash. So clearly, beyond this point, a pension starts to get less beneficial. But if you have already maxed out your ISAs, in comparison with a normal taxable investment account, where you may now have to pay 18% or 24% capital gains, a pension can still be attractive. The way to think about this is a spectrum. Those that will benefit the most from adding more to their pensions are those that know that they will go down a tax bracket in retirement, and those that are not already on track to hit the maximum tax-free cash limit. Whilst at the other end, if you're already over the lump sum allowance and you think that the tax relief you get on the way in will be the same as the tax you pay on the way out, further contributions are going to be less beneficial, which means that to answer the question of whether you should pay more into your pension, you need to understand where you sit on this spectrum. And you're only going to be able to do that if you build a financial model that projects your life into the future to try and assess what tax bands you're likely to be in at retirement. Of course, you can never know for certain, but this does not need to be exact. All you want to do is gauge whether you're likely to get more tax relief on the money that you put into your pension than the tax that you're likely to pay when taking money out. Now, none of this is new. This budget has not changed anything here. So if your goal is to provide an income for yourself in retirement, then a pension is, in most cases, your best option. But what if you are concerned about inheritance tax? What then? If you're concerned about inheritance tax, you're likely to be a higher rate taxpayer. So let's assume that you got 40% tax relief going into the pension. From 2027, both an ISA and a pension will be included within your estate and could attract up to 40% inheritance tax. If you then die, your child would end up with either £1,000 if your money was inside a pension, or £600 if that money was instead in an ISA. With an ISA, your child would receive that £600 as cash. So if they wanted to keep investing it tax efficiently, they would need to put that into their own ISAs or a pension, which is fine if it's just £600. But if we're talking about, say, £200,000, then it can be much harder for them to find a home for it. Whereas with a pension, if you died before the age of 75 and your pension provider has the full suite of options, your child could choose to keep that money inside a pension wrapper that they can control, where it can continue to grow free of tax. Then they'd pay no income tax when they choose to draw it out. But if you die after 75, they would need to pay marginal rates of income tax when they actually come to draw that money out of the pension. But what most people that are over 75 tend to do is to leave their pension to their grandchildren who aren't earning any income, because they can then draw it down from the pension gradually over time and pay little to no tax. If the child is under 18, then this process will be managed by their parents in the child's interest. However, again, not all pension providers offer these drawdown options. Some will force your beneficiaries to take all of the cash at once, which could result in them having to pay 40% or 45% income tax. So please make sure you check what death benefit options your pension provider has, because you can solve this problem very easily by transferring to a pension provider that does offer the full three. So even if you die after 75, if your beneficiaries can draw the money down tax efficiently, if you think about it from end to end, as a higher rate taxpayer, a pension is still not a bad way to pass money on to future generations. It's just not as good as it used to be. So clearly, a pension is still a very useful tool. So when then does it make sense for someone to stop paying into a pension? By the way, as we go through this, please do remember that if you have any questions, please do leave a comment below. I'm going to address the main questions that I've had from my clients in this video, but you may have a slightly different perspective that throws up different questions. So please do let me know below and I will help out as much as I can. So yeah, when does it make sense to stop paying into a pension? Again, this will depend on what you are trying to achieve, and again, you need to think about this in terms of a spectrum. At one end of the spectrum, if you are confident that you are going to need this money in retirement, then as we've seen, a pension is clearly a very effective tool. But at the other end of the spectrum, if you are certain that you are not going to use this money in your own lifetime and that you want to pass this on to future generations, then as of April 2027, there are better ways to achieve that goal than with a pension. You could just give that money away now and hope you survive 7 years. That would be the simplest option. But if you want to retain control, you could put that money into a trust or a family investment company. Or you could use that money to buy life insurance, or perhaps purchase financial products that qualify for business property relief, which means that you can get gifts out of your estate within 2 years rather than 7. These are the main options that you would consider at this point. However, they all involve giving up some element of control. So you really don't want to get this wrong and suddenly realize that actually you do need this money after all. So the first challenge then is working out where you sit on this spectrum, which again, you're only going to be able to do by thinking about the lifestyle that you want to lead in retirement and how much it's likely to cost, and building a financial model to project whether you're already on track to achieve it. Of course, we don't know what is going to happen in the future, what will happen with stock markets, how long you're going to live, or whether you're going to need later life care. But if you make sensible assumptions, you should be able to put yourself somewhere on this spectrum. When I do this with clients, I can often confidently say if someone needs to save more for retirement, as per this example here, where they're currently projected to run out of money. Or on the other hand, sometimes it's very clear when people already have enough. In these cases, it's easy to see where they sit on the spectrum, which makes the next actions clear too. But many people, especially those approaching retirement, tend to sit somewhere in the middle. They think they may have enough, but they're not sure. If that is the case, then you have to focus on your present needs first and ignore inheritance tax. You need to do whatever is the most tax efficient thing for you to do personally, which is probably going to be contributing to a pension. But let's say that you're a little further along the spectrum and perhaps you feel that even though you could use this money to make your life a little bit easier in the future, you can think of other people who would benefit more from it if you were to give it to them. Then here I think it's sensible to adopt a balanced strategy by making use of a pension, but also some of these other strategies too. I want to be clear here that at this end of the spectrum, there is no single correct strategy to follow. Each of these potential solutions comes with their own trade-offs, which means that their usefulness will depend on your personal situation and what you're trying to achieve. And even then, their effectiveness will depend on what happens in the future, which is why a balanced approach often makes sense. As you can see, retirement and estate planning has just got a lot more complicated because in the old world, if you wanted to save money efficiently for retirement, a pension was in most cases the best tool to do that. I mean, it still is. But if you also wanted to pass money on to future generations, a pension was the best tool for that too. So you never needed to ask this question of whether you have enough, because the answer was always just to put money in the pension anyway. But now, if you want to be tax efficient and leave as much money as you can to your children, you're going to need to tackle this hairy, scary question of whether you have enough, which I think is actually a great thing. Because if more people are engaging with this question, more people are actually going to realize that they can afford to retire way earlier than they expected. And more people are going to realize that they can afford to give away money and gift that money earlier on in life when it adds much more value to the recipient. So far, we've been looking at this from the perspective of someone who has cash and is wondering how to invest it. But what if you are already retired, have a lot in a pension, and are now worried about inheritance tax? Should you now change the way that you draw down from your pension in retirement? Again, this depends on where you sit on the spectrum. If you're confident that you already have enough assets to sustain you in retirement and you can start giving money away, then yes, you may need to change your approach. But if you are not at that point yet and you are in any way concerned about the sustainability of your own retirement, then I do not think it makes sense to hamstring yourself and potentially put your own retirement in jeopardy to avoid paying inheritance tax. Instead, you need to continue to draw down from your pensions in whatever way is the most tax efficient for you personally. A few weeks ago, I did a video explaining the strategies that you can use to tax efficiently draw an income from your pension in retirement. At a high level, those strategies involve trying to pay as little tax as possible when taking money from the taxable part of your pension, perhaps by drawing down up to £12,570 from it to make use of your personal allowance, and then drawing from other tax-free buckets like ISAs or pension tax-free cash to avoid having to go into the basic rate tax band. These strategies often end up with you preserving your pension for longer as you draw more heavily on other assets first, which was great because not only was this the most tax efficient thing for you to do personally, but it was also very efficient from an inheritance tax perspective. But when these new rules come into effect, what's best for you personally may not align so well with what's best for minimizing IHT. And I've had questions from clients as to whether they should now draw even more from their pensions early on, perhaps up to the higher rate tax band, and take tax-free cash now. Well, this could be a good strategy, but only if you're planning to give that money away. What you really want to avoid is drawing extra money from your pensions, paying 20% income tax on that, and then perhaps using it to fund your ISA, and then dying shortly afterwards and having to pay 40% inheritance tax on top of that. That would be pretty stupid, especially if you died before the age of 75, because if you had instead kept that money inside a pension, your beneficiary could have drawn it down without paying any income tax. But if you decide to draw extra money from your pension and you give that money away immediately, you could potentially make use of the gifts out of income exemption. If, say, you decided to sell down an ISA and give that money away, then you would need to survive for at least 7 years for that gift to be outside of your estate and no inheritance tax to be due on it. But if you make a regular gift out of your excess income and that gift does not affect your standard of living, then that money is immediately outside of your estate for inheritance tax purposes. And the money that you draw from your pension count as income in this context. However, it's the executor of your estate that will have to prove this to HMRC after you have died, so it's important that you keep very good records. So if you think about this at a high level, when making a gift by selling down an ISA or other assets, you need to survive for 7 years for that gift to be fully outside of your estate. Whereas gifts made from pension income that qualify for this rule could be immediately outside of your estate. So say you are 60 years old, in good health, and you've decided that you want to make a gift. It may make more sense for you to preserve your pension and instead make that gift from other assets, as you have a very good chance of surviving 7 years. But if, say, you are over 75 and you may not live that long, then making a regular gift from pension income can be highly effective. Again, you should only ever be making gifts if you are confident that you are well up this end of the spectrum and won't need the money yourself. And if that is the case, I would highly recommend speaking to a financial advisor at this point, because making a mistake here with these strategies can be very costly, and there may actually be other things that you could do here, potentially involving trusts or life insurance. But if you sit here on the spectrum, which most people will, then you should ignore inheritance tax completely and continue to draw down from your assets in exactly the same way as before. Which is why I suggest that you now watch this video here, where I explain how to tax efficiently draw an income from your pension in retirement, because for that purpose, the video is still valid. I'll see you there.